Here with Reaction Now, our own Laurie Rothman at the New York Stock Exchange. We have Steve Cortes, Senior Strategist at BGC Partners, and our ever-popular University of Maryland economist, Peter Morici. But before we do, let's go down to Laurie Rothman on the floor today at the MISC. Laurie, look, we've been up 42 points. It's been kind of a blah day again. Does this really have any impact? Bear in mind that this was from 3 weeks ago, and things change.
Things do change, although I don't, at first glance, Ash, see any real surprises in the minutes. It's pretty much what we expected given the last meeting, that we'll see 3 interest rate hikes here in the new year. So the Dow Jones Industrial is continuing its tiptoe toward 20,000, if you will, in the post-election rally, up 43 points. That's just about where we were ahead of the release of the minutes, but it's really just been a couple of seconds at this point. I checked some of the other things. Oil's up about 1 3/4%. We haven't, the big picture, the theme here is that we have not seen a whole lot of movement in a lot of the financial tools and a lot of the areas that we check, like the dollar, for example, which hit a 14-year high, the DXY index, which is the dollar against a basket of other currencies popularly traded against. So that's pretty much the same. It's faded a little bit. There's oil, a gain of 1.75%. Dollar versus euro, very similar to what we saw ahead of it. So, I mean, I'm kind of rambling on here, right, Ash? There's not a whole lot to report.
Never ramble. I'm on the edge of my seat, as always, Laurie Rothman. Thank you. Steve, let me bring you in. I was reading your notes. I love it. He says, for you, the most exciting Fed news is the fact the Fed is no longer such big news. In other words, get out of the way, let the economy take over. Let's get back to fundamentals. But based on what Peter Barnes just said, it does seem a little hawkish that they are expecting economic expansion and may have to raise rates.
Right. Oh, and listen, when I say that they're not news, I mean that they can normalize, in other words, that we're not going to be stuck in this it's seemingly endless world of QE. And, you know, will they or won't they QE more? So, listen, when I hear this report, I think this is just manna from heaven. We can finally get back to a real economy. Let's talk about company earnings. Let's talk about GDP. About individual earnings. Let's stop talking about the nonsense of constant central bank accommodation. And I think, by the way, that my guy Donald Trump deserves some of the credit here, and the Fed will never give him that credit. But the fact that they were able to raise rates without upsetting markets at all, global stock markets are doing fantastically, and the fact that they have the confidence to continue to do so into 2017 is because I think Donald Trump, through his policies, and by the way, also just through his rhetoric and his confidence, is going to usher in a new era of growth and prosperity for the United States.
Peter Morici, I don't think they're exchanging Christmas cards, but Donald Trump and Janet Yellen kind of, you know, there's a kind of a symmetry here, because I think Donald Trump, or Trumponomics, whatever you want to call it, makes it easier for the Fed to do what it does. To Steve's point, kind of get out of the way, let the economy do what it does, let the market figure itself out, and we get back to those fundamentals.
Well, if we cut taxes, remove regulatory restraints, and do something constructive about the trade deficit, more than just moving a few plants back, then the economy will start to grow more from its own initiative and won't require a lot of accommodation to do so. You know, there's nothing wrong with having a federal funds rate of 3% at the end of 2018. Or 19, simply because that puts it in line with inflation and establishes a real rate of interest where people are getting a real return on their fixed income investments. And when you get to that point, you have a healthy economy. So the notion that we're going to raise rates next year, you know, 3 times, I'm a little skeptical. I think it's going to end up being twice, simply because it's going to take time for the policies to have traction. And I don't think oil prices are going to jet much higher than they are now. Underlying inflation is about 1.82%, 2.1%. So my feeling is that we're moving in a positive direction. It's going to take time for its policies to have traction, but confidence is developing that America is coming back.
And Steve, back to you quickly. I mean, listen, you know, the fact of the matter is that there's a belief that what the policies of Donald Trump will do is allow the Fed to raise, even if it's a 1/4 point along the way. The economy should be in a position where it doesn't matter. It's strong enough, bigger enough, you know, expanding enough to handle a 1/4% rate hike.
Right, and that's what I'm saying. I think that if the economy were a bike, we can now take off the training wheels and we're not going to fall down.
Yeah.
And I think we would have fallen down, and we certainly did, by the way, at this time last year. If you remember, back to January of 2016, after the Fed hiked in December 2015, global markets fell apart that January. I do not believe that's going to happen now. Why? Because markets are so optimistic that we can grow at the level we should be accustomed to as Americans, and that we're going to have the right policies for growth going forward.
That's all about optimism.
Do I have time?
Yeah, go ahead, Laura.
Hi, Ash. I just want to add this. Let's be real careful of buy the rumor, sell the news. Mark Fields, right, the CEO of Ford yesterday, saying he's on board the Trump pro-growth, economic growth agenda. He likes it, but you know what? He's not even inaugurated yet. Okay, so this whole post-election rally, it's a lot of buy the rumor. We're seeing a lot of hesitation here. The Dow count hit 20,000. There's a lot of talk here on the floor that we may be ahead of ourselves in terms of U.S. equities. To a certain degree, if we didn't have Trump and all of the optimism associated with what he's promising business and folks, tax cuts, et cetera, and infrastructure spending on and on and on, how would this market have absorbed the Fed rate hike and a promise of 3 more? I mean, to a certain degree, both are mutually exclusive.
Yeah, go ahead.
To look ahead, I think we need to start to refocus on European politics. For example, in France, the center is starting to find a winning formula.
Yes.
You know, there's a difference between Donald Trump becoming president and having a speaker, Ryan, and Le Pen capturing, France. My feeling is that the political situation in Europe will now start to stabilize. They'll get a better grip on immigration, and it will start to stabilize. And as that happens, the European economy, the European markets, more confidence, and that is a good thing. We shouldn't view it as there's only so much growth out there. My feeling is that we are in for some positive surprises from Europe, and I hope so, because there are, financial bubbles out there that growth would accommodate, would help us get through. And if we don't have that growth, then those financial bubbles become more problematic.
Yeah, true. Listen, it's January 4th. I love the optimism. May it forever last as we head into more and more and deeper into the new year. Laurie, Steve, and Peter, thank you very much.